Welcome back to Factful Finance, where we help you navigate the world of money with clarity and confidence. Tax season is just around the corner, and you may be wondering, how can I make sure I'm maximizing my return? Well, you're not alone. Many people leave money on the table simply because they don't know how to take full advantage of the options available to them. But what if I told you there are simple, actionable steps you can take right now to ensure you get back every dollar you deserve? Let's dive into those tips and strategies that can help you maximize your return in tax season 2025. Before we jump into the tips, a quick note. The advice here is for educational purposes only. For personalized guidance, be sure to consult with a qualified professional who can tailor strategies to your unique situation. Now let's get started. First things first, maximize your deductions. This is one of the easiest ways to reduce your taxable income. But did you know that many of the common deductions go unnoticed? Take the home office deduction, for example. If you've worked remotely or had a dedicated workspace at home, you might qualify for this deduction, even if you're an employee, not just a business owner. According to the IRS, you can deduct a portion of your rent, utilities, and even home insurance based on the percentage of your home used for work. So if you've got a home office that takes up 10% of your living space, you could deduct 10% of your home-related expenses. That's a pretty significant potential saving. And let's not forget about medical expenses. Did you know you can deduct medical expenses that exceed 7.5% of your adjusted gross income? So if you have had significant medical costs, such as surgeries or prescription drugs, this could make a real difference in your return. Next up, contribute to retirement accounts. Did you know you can reduce your taxable income by contributing to retirement accounts like a 401k or IRA? These contributions not only help you save for the future, but also lower your tax liability for the current year. For example, if you contribute $6,000 to an IRA, you can reduce your taxable income by that same amount. For those under 50, the limit for IRA contributions in 2025 is $6,500, and for 401ks, it's $2,250, though catch-up contributions can increase that if you're 50 or older. Consider this. If you were planning to invest $6,000 anyway, why not do so in a way that reduces your tax bill? It's like getting two benefits for the price of one. And while we're on the topic of savings, let's talk about tax credits. Many people confuse tax deductions with tax credits, but they're not the same thing. Tax credits are even better because they directly reduce your tax liability dollar for dollar. For instance, the Earned Income Tax Credit, EITC, could provide you with up to $6,935 if you qualify, depending on your income and family size. Make sure you check whether you qualify for credits like this. It could result in a substantial refund. Here's another one. Track your investment losses. A strategy known as tax loss harvesting can be a powerful tool, especially for those with investments in taxable accounts. The concept is simple. If you have investments that have lost value, you can sell them and use those losses to offset gains you've made elsewhere in your portfolio. So, if you sold stock for a profit earlier in the year and now have a loss in another investment, you can offset the two to lower your tax bill. It's a win-win situation. But be cautious. There's a rule called the wash sale rule that says if you sell a stock at a loss and then repurchase it within 30 days, you can't claim the loss. So, make sure you're paying attention to the timing of your sales. Now, one tip that doesn't get enough attention is keeping good records. With all the deductions, credits, and exemptions available, it's easy to miss something if you don't stay organized. Whether it's your medical receipts, your 401k contributions, or your home office expenses, keeping all your documentation in one place can save you hours of headache when tax season rolls around. Using a tax prep app or keeping a simple spreadsheet of your expenses can go a long way in making sure you don't miss out. Let's also consider a tax-advantaged savings account, like an HSA, health savings account. If you have a high-deductible health plan, you can contribute to an HSA to reduce your taxable income, all while saving for future medical expenses. Contributions are tax-deductible, and any funds you withdraw for qualified medical expenses are also tax-free. Plus, the unused funds roll over each year, meaning it can serve as both a health and retirement fund in the long run. Before I wrap up, I want to share a real-world example of how these tips can work in your favor. Let's take Sarah, who's in her 30s and works as a marketing manager. In 2024, she made $80,000. By contributing $5,000 to her 401k, Sarah was able to lower her taxable income to $75,000. She also has a home office and was able to deduct $1,200 of her home expenses. On top of that, Sarah sold some stocks she'd held for a few years, and because of tax loss harvesting, she reduced her capital gains taxes by $1,500. After adding a few credits she was eligible for, Sarah's refund was over $5,000 higher than it would have been had she ignored these strategies. So let's recap the key tips. Maximize your deductions. Contribute to retirement accounts. Take advantage of tax credits. Track investment losses. Keep good records. And don't forget about tax-advantaged accounts, like HSAs. Tax season doesn't have to be stressful or confusing. With these simple strategies, you can take control and ensure you're getting the maximum refund possible. What's the first step you'll take to maximize your return this year? Share your thoughts in the comments below. We'd love to hear from you. And as always, thank you for visiting Factful Finance. If you found this information useful, why not hit that subscribe button so you don't miss out on our future videos packed with expert tips and actionable advice to help you build a stronger financial future. We'll see you in the next video.